Thank you so much for joining us today for our Q3 US Economic Update. We are thrilled to bring you this event today with our partners at JPMorgan Chase. And in today's session, we have a very special speaker for you today. And we're so excited to be able to provide you valuable insight and a stronger understanding of the current economic trends to help empower you to shape your financial future. So quick housekeeping throughout the webinar. If you have any questions, please be sure to use the Q&A button at the bottom of your screen. We will be saving some time after today's presentation and going through those questions. So please make sure that you do include them in there. Now joining us today, we have Ms. Stephanie Roth. Stephanie is a senior economist for global wealth management at JPMorgan. And in this role, she drives the U.S. macro outlook through economic and quantitative analysis, with a particular focus on business cycle dynamics. Ms. Roth advises high net worth clients on the economic outlook and how that impacts asset allocation within the context of their overall investment portfolio. So we're very happy to have her joining us today. And Stephanie, I'll go ahead and pass it over to you.
Great. So good to be here. Thank you for having me. So it's definitely been a complicated environment. Economics have been in focus over the past two years or so, or even more. It's been very important and very volatile because there have been a lot of dynamics at play. And I would say a lot of that ties to the Federal Reserve and inflation. So a lot of what I'll speak about today all rolls back to these common themes. And I have some slides for you. Maybe we'll kick off with the first slide here. So many economists have expected a recession to play out in this economy. And a big reason is because the Fed doesn't typically raise interest rates as quickly as they have. That's kind of an unusual dynamic. And that's happened because inflation has been quite high. So inflation last year, and we focus on core inflation, so we strip out food and energy prices, and that was trending at around 5 or 6% for a lot of last year. And the Federal Reserve, and they're in charge of keeping employment and inflation in check, their target for inflation is about 2%. So there was a very wide difference between the two. So in order for the Fed to get inflation back under control, they had to hike interest rates, and they did so very quickly. That's their main policy tool that they can use to fight inflation. So what they did was in 2022, they raised rates very aggressively. They hiked rates by nearly 500 basis points, or going from about 0% to about 5% over a fairly short period of time. And that tends to have consequences for the economy. So that's why a lot of economists were anticipating a recession at some point over the next year or so. Our base case is the economy will probably slip into recession. It's not a done deal either way, but what we do expect is a significant slowdown in growth, because that's what the Fed is trying to do. They want to slow down the economy in order to get a handle on inflation. And last year, that hurt both stock and bond markets, because stock markets were worried about the outlook. They were worried about the Fed hiking interest rates. And the bond market tends to correlate with what happens with Fed policy. As the Fed hikes interest rates, they hike rates on the Fed funds rate, and that has an impact across the bond curve, and that impacts rates everywhere. So from that perspective, rates rose really quickly, and when rates go up, the bond prices go down. There's an opposite relationship. So last year, all investors had a really tough year. In fact, it was one of the worst years for investors who invest in both bond and stock markets since the 1980s. So it was a very historic year from that perspective. And this year, we're seeing a bit of the opposite. And if we can go to the next slide. It's actually been a very good year for most asset classes. And you'll see here, this is the year-to-date returns for many asset classes. So you'll see that US equities are up pretty significantly. They're outperforming, but rest of world has also done fairly well. European stocks have done well. A lot of areas within the bond market, high yield bonds have done well. So it's been a much different year this year than last year. And a big reason for that is because inflation is starting to come down. So markets are feeling a bit more comfortable about the outlook, and that's for good reason, because there was a risk last year that inflation was going to just remain incredibly high and the Fed was going to have trouble getting it under control. But we're now seeing that the Fed is in fact having an impact, and then on top of that, just moving past the COVID pandemic is also putting some additional pressure on inflation. There were some elements of COVID that created some of these inflationary pressures, and now that we're living our lives a bit more normally, that's coming out of the data, and inflation is now settling closer to 3%. The Fed's target is 2%, like I mentioned, so 3 does not equal 2, but we're definitely a lot closer than where we were. So the markets definitely like that, and for good reason. But being that markets have done fairly well, and we still think that the outlook is quite uncertain from here. So if we go to the next slide, there's been a lot of differentiation in terms of market returns. Some stocks have done better than others, and that's always the case to some extent, but this year it was particularly extreme. So for the beginning part of the year, especially when news came out about AI and the impact on certain stocks, that really drove tech stocks up. And tech stocks significantly outperformed for a lot of the time, and that left the rest of the index underperforming. Over the past month or so, you've started to see that correct, and you're starting to see the rest of the stock market catch up. So we still think that there's more catch up to come, and the stocks that are not the absolute largest in the S&P 500 may continue to outperform for some time. And that's what we're showing for you here. The orange line is the tech sector, and we're showing the multiple, or the kind of the valuation for tech stocks compared to the rest of the market. And what we see is that while some of those hefty tech stocks are fully valued today, there's a lot of opportunity in the rest of the market. So this is an important potential opportunity over the coming months, is that some of the smaller cap stocks may potentially outperform. Our favorite part of the equity market index is the mid cap part, because that's kind of a nice sweet spot. It's not fully valued the way the largest of the companies are, but it's also a little bit less sensitive to the economy. The smaller cap the company, the more sensitive it tends to be to economic dynamics. So the smallest companies we're just a little bit more cautious of, especially given some of the dynamics that happen within the banking sector, and we can get into that a bit later. But that tends to be a bit more of a challenge for some of the smallest companies in the economy. So what does that mean? Let's jump ahead 2 slides. So what are we left with? We're left with an economy that is late in the economic cycle. And that's important for how we think about investment decisions. And what do I mean by where we are in the cycle? And this is an index that we've created that helps us numerically gauge what part of the cycle we're in. Right after recession, you tend to be early in the economic cycle, but it has nothing to do with the length of time, how soon after the recession you are. It's more about excesses in the economy. How high is inflation? How much has the Fed raised rates? How much debt there is in the economy? And that has a bigger impact on where we are in the economic cycle than length of time. And this helps us measure that. And it's important to be aware of where we are in the economic cycle when you're thinking about your investment decisions. Early in the economic cycle, you might be more willing to take risks in a business, or you might be more willing to add some debt and expand your businesses, because the prospects might be more favorable, interest rates might be lower. It tends to be a part of the cycle where stocks tend to outperform, and it's kind of a broad recovery after a recession. The middle part of the cycle is a bit more quiet. It tends to be the part of the cycle where the winners and the losers differentiate themselves. It tends to be a little bit less volatile because you're not recovering from the last cycle and you're not yet worried about the next recession that they may or may not be coming. So it tends to be kind of a nice, quiet part of the cycle. And then the late cycle, which is arguably where we are today, is where volatility tends to be high because there's so much uncertainty. it tends to be a part of the cycle where the Federal Reserve is starting to hike interest rates, which has a lot of knock-on consequences. So investors, rightfully so, tend to be a bit more cautious, and then tend to hang on to every economic data print because they're worried about the next potential recession, knowing that it's very possible it will be around the corner. So even if we don't get a recession in, say, the next 6 months, our base case is that we will. But if we don't, we do think that we'll remain in this late part of the cycle, and recession might be, kind of looming around the corner for some time. So that's kind of how we think about the economic cycle and how to invest in it. It's very important to be aware of that, especially if you're managing a portfolio. You probably want to take fewer risks when you're late in the cycle, because it's just possible that things can go wrong unexpectedly. So it's very hard to get out of the late part of the cycle unless you get a recession or something sort of shocks the economy that leads to a big growth slowdown. So what I mean by that is you'll see this blue line tends to continuously rise over time until it has a gray bar after that. The gray bar signifies recession. So we tend to just progress throughout the cycle. Excesses tend to build, and then you hit recession and you get a bit of a reset. So that does mean that we're expecting at some point there to be that reset. Hard to know exactly the timing, but just given how much the Fed has had to raise interest rates and fight inflation, it does seem like it's sooner rather than later, even though the economy has been holding up okay so far. So let's do a bit of a check-in in terms of what the Fed is looking at, because really the Fed is such an important driver here. They're going to be a big driver of the macro cycle over the next couple of months and quarters. And a big reason is they've raised interest rates really high, and it's been the fastest hiking cycle that we've had since the 1970s. And growth is likely to continue to be under pressure until the Fed is able to say, okay, inflation is over. We feel good about it. Now we can cut interest rates, because they've raised rates so much that it's at a restrictive level. And the economy is going to continue to be under pressure until the Fed feels okay backing off of that. And they're not there yet. So they're paying attention to two important things: the labor market and inflation. That's their mandate. They have a dual mandate. Let's jump ahead. Let's do a check-in on the first part of their mandate, and that would be inflation. And the chart on the top left is one way that Chair Powell, and he's the comes out and talks every 6 weeks or so about where we are in the economy. They make a decision about interest rates, and he continuously mentions this chart on the top left: core CPI or core inflation over 3, 6, and 12 month time horizon, just to capture the number of different time periods. And this wasn't updated yet for yesterday's print, which actually was a good one, meaning inflation continues to come down. But what he had been looking at was this level that was quite a bit higher than what the Fed's target is. So in an ideal world, these lines would be trending around 2%, and clearly it's much above that. And at some point on shorter time horizons, it was trending well above 6%, which is unacceptable to the Fed. And they were willing to sacrifice economic growth in order to get inflation back down to 2%, because that's destabilizing for the economy. So right now, if we were to update this chart, you would see these lines coming now down to about 3 to 4%. So a lot of work has been done, but we're not there yet. The Fed isn't going to feel comfortable cutting rates until we're even closer back down to that 2%. So there's been progress, but not quite there. And when I think about what happened from an inflation perspective, there's three main stories that happened. So inflation, and this is why the Fed was arguably late to the inflation problems that we were having in this economy, was because they were paying attention only to chapter 1 of the inflation story. And that was that goods prices picked up during the pandemic because there were supply chain issues, because everybody wanted the same type of goods all at the same time, and that just drove up prices for goods, especially car prices. That had a significant impact on inflation. And their opinion was, well, once the pandemic is over, there will be a lot less demand for those goods and goods prices can come down. And that's the middle chart that you see here. This is a measure of supply chain pressures. So as soon as supply chain pressures eased up, goods inflation came back down, and that story kind of played out as expected, although it did take quite a bit longer than the Fed anticipated. What they missed was that service inflation picked up. And what I mean by that is inflation that we all pay on a day-to-day basis for services that we consume. So for example, if you go to a restaurant, you probably noticed over the past year and a half that at times they put a note that said we had to increase our prices because costs went up. I definitely saw that at the hair salon, for example. There was a big sign that said, prices are higher until further notice. So services or businesses that are fairly labor intensive, meaning that a lot of their business is related to the workers that work there, had to pay higher for those workers because it was hard to attract talent. And in doing so, they had to raise prices, and that put pressure on inflation. So this was the second pillar of inflation. And this is what the Fed perhaps missed, or at least was late to. And this is what drove a lot of the inflation that happened last year. And this inflation tends to be very long lasting. And this is what the Fed is fighting. The last pillar of inflation is related to the war in Ukraine, and that was food and energy prices. Those went up and have largely come back down. So that has kind of played out. So it's more about this sticky service inflation. And I'll ask that you pay attention to the bottom right chart here. This is core service inflation, and we take out rent inflation from this. And it's gotten a lot better. And if we were to update it for yesterday's print, you'll see it's come down even further. So we've made a lot of progress there. We're just not quite there. And the Fed is not necessarily even just concerned about the inflation rate today, which of course they're worried about, but they're also worried about a really strong labor market risking inflation in the future. So the dynamics there are such that if companies have trouble hiring, there's not that many people left to hire, they're going to continuously have to raise their wages. They raise their wages, and it creates this loop. Higher wages means they're going to have to charge their customers more, and it creates this dangerous loop of inflation that's linked to wage pressures. So the Fed wants to make sure that that the labor market isn't too tight, where there's just too little of a supply. So what they want to do is they want to slow down the economy, which eventually slows down the demand for labor. So it might seem counterintuitive that the Fed wants to see some layoffs, but they kind of do. They want to see a little bit of layoffs just to ensure that inflation won't pick right back up as soon as the Fed is done with their hiking cycle. So let's do a check-in on the labor market on the next slide. So here are some key pictures when we think about the labor market. And you've started to see some improvement. There some of the metrics have softened a little bit. So maybe let's focus on the middle chart here. Here's temporary employment compared to overall employment. And you have seen, although you might have to squint to see it, you have seen temporary employment, that's the blue line, roll over. And that tends to be a leading indicator of overall employment. If you're a business and you are facing some cost pressures, you're most likely to reduce the hours or reduce the people of your temporary employees because they're perhaps less integrated into your business. They don't have the same benefits. It's just kind of the first type of labor that you're likely to cut. And you have seen that roll over the past couple of months. And that's just a sign that you're continuing to see some of this labor market weakness. It's not significant yet, and we haven't seen broad-based layoffs in this economy, but this is the early signs of it. We have seen layoffs in the tech sector and a little bit in finance. That's the chart on the right. So it's the very early stages of some signs of labor market weakness, but it's not weak overall. The labor market so far has been held up better than many people had anticipated. And that's good and bad. It's good, of course, from a humanitarian perspective that people are fully employed, but it does create pressure because on the bottom left chart, here's a chart of wages. The preferred measure from the Fed is that light blue line, and they still remain kind of high. And that just, ties to the conversation earlier about a spiral between wages and then prices. So the Fed wants to see these wages come back down closer to 3%. That would be more consistent with their target. And we're just not quite there. But some good news is that within a tight labor market, you tend to see some of the gaps or the gaps between demographics start to narrow. So if we jump to the next slide, a tight labor market tends to reduce unemployment rates across demographic groups. And we have seen that over the course of this cycle. So that's definitely been an important positive. And that's something that the Fed looks to especially over typical cycles, particularly when there isn't an inflation issue. They like to see the economy run fairly strong because that tends to reduce the gaps between different demographic groups. So this cycle has helped to narrow that. They just need to balance out the conversation around labor, the demographic labor trends, and the fact that they do need to get inflation down. And they're willing to sacrifice a little bit of the improvements on the labor front because their credibility is on the line when it comes to inflation. So if we jump to the next slide. So we do think that we'll probably see some layoffs. Whether we get a recession or not is an important question, but perhaps it's less important than it seems because the recession might be less severe than was potentially the case 6 months ago. Now that inflation is back down, it's possible the Fed needs fewer layoffs in order to feel good about their inflation target. So when I think about the roadmap to recession, it usually starts on the top left with a very aggressive Fed hiking cycle. We've certainly gotten that. That's the blue line. That's a very steep line. Rates went up very quickly. The housing market tends to get hit. We have seen that. That's the bottom left chart. The housing market did get hit last year, and now it's kind of stabilizing around its current levels. And then the next things that we're looking at to see if we'll get a recession is what happens from an earnings perspective. And right now, earnings have actually declined a little bit on the S&P 500, but some of that has to do with some rebalancing within the tech sector. And smaller cap companies and the median company isn't actually that negative. So that tells you that the average company in public markets today, the earnings growth have slowed. There have been some headwinds, but it's not looking overly recessionary right now. It looks more like a bit of a reset. This is kind of where we're stuck at the moment. If in fact we get a recession, what you would likely see is company earnings would look a lot worse. Companies would need to protect their earnings, and there's two big ways that they spend money. One is investment in their own businesses, and two is hiring people. So if the companies really need to save money, they'll reduce investment and they'll also reduce their hiring, or in fact do some layoffs. So we're not necessarily there yet, or at least not on a broad scale. And then the things that would follow that would be the labor market would cool, and so would inflation. But those aren't leading indicators for a recession. Really, what's leading for a recession is what's happening from a company's perspective. Companies' profits are perfectly fine while inflation is coming down, then they're not going to feel the need to do the layoffs that might have been the case. So where do we stand right now? Let's jump to the next slide, and then I'll reserve some time for questions. There's certainly a lot more we could go through. The next part of the deck would have been about the banking sector, and I'll see if there's questions there. But what tends to happen is when banks are under stress, they'll reduce the loans that they offer to people, which tend to slow down the economy. So that's kind of one thing that's likely to help the Fed bring down inflation even further and slow down the economy. Banks are a little bit more cautious. But right now you have seen a slowdown in the economy. That's what the Fed is looking for. The left chart shows a measure related to housing. That's likely to continue to be kind of sluggish here. The middle part is capital spending. You have seen a slowdown. And on the right-hand side shows the consumer. And right now, there are starting to be some signs of cracks for the consumer, but the consumer is still in okay shape. Consumer balance sheets are pretty good, meaning they've paid some of back their debt during the pandemic. They weren't that indebted in the first place. So they're kind of looking in okay shape. And the consumer tends to be the last part of the economy that feels the pain from a Fed hiking cycle, because they're a little bit less interest rate sensitive, meaning they don't have as much debt. A lot of consumers tend to make purchases either with cash that they have, they just spend their income and buy things. And they tend to, even if they're taking out credit card debt, they might pay it back rather quickly. So they tend to be a little bit less sensitive to when the Fed is hiking interest rates. So that tends to be the last part of the economy that slows down as a result of Fed hiking cycle. So as of now, we have gotten a slowdown. That's a positive. It's likely more slowing is coming ahead. But that doesn't mean that there's nothing to do from an investment perspective. I mentioned earlier that there's parts of the equity market that are attractive here, and perhaps the biggest names in the S&P 500 are a little bit overvalued here. And we think that there just could be a bit of a catch up for some of those mid-cap names. So that's one area of the equity market that we really like. Mid-cap equities. We also like European equities because they are also a little bit less expensive. There are some significant potential growth drivers there, especially China reopening. There's a lot more to come because it's been a very slow reopening. And then within the rest of your portfolio, buying bonds is really attractive here. And this is something that people haven't really talked about for the past 10 years or so, because rates have been low. But now that the Fed has raised rates, your yield is pretty good. So you can get a pretty okay return in a very low risk way. So putting money from cash into something that's a little bit longer duration, you could lock it in for a number of years, really makes sense in this environment. Sitting in cash might feel okay today because the Fed has raised rates a lot. But as soon as the Fed cuts rates, then the cash that you're getting and being offered in a CD or your savings account is going to go down, and you're going to wish that you locked it in for a longer period of time. So we're advising that clients take their cash, put it to work in something that's a little bit longer duration, because that's a way to take today's yields and lock it in for a period of time. So while many are focused on the potential recession, it's likely to not be all that bad. They're given that there's not that many excesses in the economy, given that inflation has already come down some. We're not looking at a financial crisis. We're not looking at anything that was as serious as the past two recession, even though there might be some recency bias. It's likely to look more like a normal run-of-the-mill recession, meaning if in fact we get a recession or just a slowdown, it would mean that some companies have to trim some staff, but and growth will slow down, but nothing like a crisis situation. So from that perspective, things look okay. Yes, markets have run a lot this year, but it still makes sense, especially if you have a long-term perspective to put money to work. You tend to lose out if you sit there waiting to time the market. That's a very hard thing to do. So we generally don't advise that. And we would suggest that, you could leg into the market, add a little bit of money over time to get to the proper allocation that you might want at the end of the day. So it's not such a rosy outlook, but it's not that bad either. And it's certainly better than where we were a couple of months ago. And that's one reason why markets have done so well this year. And we continue to expect that markets should grind higher and that yields should come lower, especially as the Fed is able to cut interest rates back to something that's a bit more normal. 5% is not typical for this economy. So I talked a lot. I can pause there and see if there's any questions or if we should wrap up.
Thank you, Stephanie, for providing such valuable insight. We do have one question here about their diversifying investment portfolio. So really, when people are thinking about diversifying their portfolio, are there any recommendations from an economist perspective as to when they should be thinking about going through that process in that economic cycle?
Definitely. I'm always a big fan of diversification. Because if you pick what was the winner of the last cycle, it's possible you'll be wrong, and then the next cycle, whatever the leadership is different, and then you might be completely allocated in the wrong way. So it very much makes sense to have a properly diversified portfolio given your risk tolerance and your liquidity needs. And I would think about diversification in a whole host of ways. One would be within your equities to have a diversification from a regional perspective. So to have not just all of your money in US tech, think about having a diversified portfolio across sectors, across countries. And you can think about the MSCI World, for example, as a way to think about a benchmark of what's the sort of typical weighting. So having something like 60% of your equities in the US tends to be sort of consistent with a normal type of benchmark. Otherwise, you want to think about diversifying within asset classes. So having, a decent equity portion, but then also having money in fixed income, because fixed income tends to protect your portfolio when things go wrong. So if you were to, in fact, have an economic recession, your equities will probably go down, but your bonds will go up. So if you have bonds in your portfolio, that will actually sort of buffer your portfolio from a downturn in the economy. So it makes sense to think about not just within your equities, but also broader speaking from kind of a multi-asset or a lot of different types of assets. And I would think about that as always, not something that I wouldn't save diversifying for a certain part of the cycle. I would always want to run a diversified portfolio, and then dial up the risk depending on where you think we are in the cycle or your concerns or, liquidity needs. But I would always think about a benchmark, normal portfolio that's well diversified.
Fantastic. Well, thank you so much for your time, Stephanie. We truly appreciate you sharing your expertise and your insight with us. We hope everyone will be able to take this knowledge back to their communities and continue to, as you mentioned, diversify their portfolios and truly empower them in their financial decisions. So thank you again for joining us today.
Thank you for having me.
Have a great one. Bye-bye.